Balance of payments deficit. A balance of payments deficit is where our imports are greater than our exports. When economists speak of a balance of payments deficit, they mean a deficit on the current account. Now, a deficit on the current account would not be a source of concern if the deficit followed a number of years of surplus, if the deficit is covered by a surplus on the capital account, if a large part of the deficit arises from the importation of capital items that will increase the future productive capacity of the country, exceptional items, or the importation of raw materials. However, if a deficit on the current account is a regular occurrence, then it will be a cause of concern and the government will have to take steps to improve our balance of payments. Now, what does the government have to do to reduce a balance of payments deficit, just in case it does become a problem? The government may try to reduce imports by the use of quotas, tariffs, etc. The government could pursue a policy of import substitution. In other words, encourage consumers to switch some of their spending from imported goods to similar home-produced goods. A range of measures could be introduced to encourage exports, such as subsidies and tax reliefs for exporters. And lastly, an incomes policy could be introduced where only modest wage increases are allowed. Workers then would buy fewer imports. Here's another type of question that can be asked. Outline the economic consequences of a balance of payments deficit. Now remember, a balance of payments deficit is where our imports are greater than our exports. Income leakage from the economy. As imports are a leakage from the circular flow of income, the multiplier is reduced in size and so national income falls. Reduction in our external reserves. If our external reserves are used to finance this deficit, then we reduce our ability to make international payments. Increased foreign borrowing. If borrowing is used to finance this deficit, our national debt will increase, placing greater burden on taxpayers. And job losses. If imports are bought in preference to Irish produced goods, it may result in job losses in those domestic industries that could be forced to rationalise. Now we look at the economic consequences of a balance of payment surplus. So this is where our exports are greater than our imports. Increased domestic earnings. If exports are greater than imports, exporting firms will increase their profitability. Increased employment in export-oriented firms. With exports increasing, employment will increase in exporting firms. Increased demand for imports. With increased demand for exports, Irish firms will need to purchase new machinery to cope with the increase in demand. Imported raw materials will also need to be purchased. Inflationary problems. With an increase in the demand, prices will rise, leading to inflation. All right? Because if our exports are greater than our imports, then the injections are greater into the circular flow of income, which will create demand, which will increase prices. And finally, then, we're going to look at here, on this segment, is what impact do multinational companies have on the balance of payments on the current account and capital account? Now, this is very interesting. So look, the first part is to do with the current, and the last part is to do with the capital. Foreign firms bring staff from their home country to Ireland. As a result, a portion of their salaries earned may be returned home, i.e., that would be an invisible import. Number two, in order to create output, multinational companies purchase raw materials from abroad, i.e., that would be a visible import. Many multinationals export their produce, therefore that's a visible export. And many multinationals repatriate their profits, that would be an invisible import. On the capital side, when foreign firms come to Ireland, they bring additional capital investment machinery with them. This is a capital inflow.